was also called ARM. And basically, audit risk is the risk or likelihood that the auditor may unknowingly fail to modify the opinion on financial statements that are materially misstated. In other words, an unqualified opinion on misstated financial statements. So you don't want to be in that situation, an auditor, where you give the stamp of approval, they're A-OK, and they have lots of problems. And that's happened. I mean, what happens is they get slapped, the company may get sued, and what happens usually, SEC usually settles out of court, and it's a big fine. But you can go to websites, and the SEC has a listing of the firms that are been slapped on the hand and what their fines are, and all the big four are on there. So, I mean, some years are bigger than others. And so how willing is the auditor to accept the financial statements that may be materially misstated after the audit has been completed and the report issued? The audit risk model basically breaks down overall audit risk into three components. You have inherent risk, which is IR. You have control risk, which is CR. And detection risk, which is DR. And AR equals IR times CR times IR. And they have the inherent risk and control risk, which equal the risk of material misstatement. So, like we said, the two big items for assessing the material misstatement is the inherent risk and the nature of the company and how they operate, and the control risk, what are their internal controls to handle the risks that are identified. And there's a direct relationship between audit risk and detection risk, inversely related to evidence. So the lower the AR, the lower the DR, the greater the evidence is required, or the more evidence is required, the more sampling is required to do the audit, complete the audit. So there's also some limitations in the model, like you can't always achieve the actual level of desired audit risk. And the audit risk is actually, like we said, well, it could be, let's say you decide based on a preliminary analysis of the company and you want it to be 3%. So that AR is assigned to a number of 3%. Then the other two numbers have to be filled in. I mean, that's where you come in and you give levels for the control risk and the detection risk, what's acceptable. But it has to meet that AR number. It does not consider potential auditor error, which is a big one. I mean, auditors are human beings, and even in this day of internet technology and information systems, there's still room for error, because at some point machines can't make decisions all the time. It's up to your professional judgment. And there's no way of knowing really what the preliminary level of audit risk really was. So all these are issues.